ETFs are one of the best ways to build wealth in the stock market, and it's no surprise they've exploded in popularity.
ETF.
But how do you actually invest in ETFs? This is the ultimate guide that will take you from complete beginner to confidently building your ETF portfolio. I've spent years analyzing what actually works for new investors, and I've packed this video with actionable strategies and insider tips that most people have never heard of. So let's dive in and turn you into an ETF investing pro. If you need a refresher on what ETFs actually are, I have a quick video explaining the difference between ETFs and stocks. Make sure to check out that video first and come back to this one after you're done, because understanding the basics will make everything else in this guide much clearer. Alright, let's walk through this step by step. The very first thing you need to decide is what your goal is. Are you investing for retirement, or are you investing to reach goals before you retire? Like buying a house, starting a business, or just building wealth you can access anytime. This matters because there are two types of accounts you can use, and your goal determines which one makes sense for your situation. Standard brokerage accounts are like a regular bank account, but for investments. You can put money in anytime, buy ETFs whenever you want, and take money out whenever you need it with no penalties. The downside? When you make profits, you'll pay taxes on them. But the upside is complete flexibility. No age restrictions, no withdrawal penalties, no contribution limits. Retirement accounts like 401ks and IRAs come with amazing tax benefits, but also strict rules. With a traditional IRA, you get a tax deduction now and pay taxes when you retire. With a Roth IRA, you pay taxes now, but your growth is completely tax-free forever. The catch? You generally can't touch this money until you're 59 and a half without paying penalties. Most people who are investing for retirement prioritize retirement accounts first because of those tax benefits. Most people investing for shorter-term goals use standard brokerage accounts for the flexibility. And many investors end up using both types of accounts for different purposes. Now, where do you actually open these accounts and buy ETFs? You need to choose a brokerage firm. The most popular options are Fidelity, Charles Schwab, Vanguard, TD Ameritrade, and E-Trade. Most of these offer both standard brokerage accounts and retirement accounts. When choosing a broker, most people look for a few key things: commission-free ETF trading, low account minimums, a good mobile app, and access to a wide variety of ETFs. The good news is that most major brokers now offer all of these features, so you really can't go wrong with any of the big names. Now that you understand which account types exist and where to open them, let's talk about how much money you actually need to get started. Here's where most people get it completely wrong. You don't need thousands of dollars. You don't even need hundreds. Thanks to something called fractional shares, you can start investing with literally $1. Let me explain how this works. In the old days, if you wanted to buy a share of an expensive ETF that costs $400, you needed exactly $400. But now, most brokers let you buy a fraction of that share. So with $1, you could own 0.0025 of that share. It sounds tiny, but here's the thing. That tiny piece grows at the exact same rate as someone who bought the full share. The final piece you need to understand is costs. There are really only two costs that matter for ETF investing. First is the expense ratio. This is like a yearly fee the ETF charges, usually between 0.03% to 0.75%. So if you invest $1,000 in an ETF with a 0.1% expense ratio, you're paying $1 per year. That's it. Now you might be thinking, $1 per year? That's nothing. But here's why this matters more than you think. These small percentages compound over time and can seriously limit your returns. Let me give you an example. Say you invest $10,000 in two different ETFs. One has an expense ratio of 0.5% and another has 1%. After 30 years, assuming 7% annual returns, the low-cost ETF would be worth about $66,143. But the high-cost ETF? Only about $57,434. That's an $8,709 difference just from that small percentage difference in fees. The reason this happens is because those fees come directly out of your returns every single year. So you're not just losing the fee money, you're losing all the compound growth that money would have generated over decades. This is why most successful ETF investors obsess over keeping expense ratios as low as possible. The second cost used to be trading fees. Brokers would charge you $5 to $10 every time you bought an ETF. But here's the good news. Most major brokers like Fidelity, Schwab, and Vanguard now offer commission-free ETF trading. So you can buy and sell without those fees eating into your returns. The bottom line is this: you can start investing in ETFs today with whatever money you have, even if it's just a few dollars. The barriers that existed 20 years ago are gone. Look, my whole mission with this channel is to give you the financial education that can actually change your life. Because understanding how money works is the first step to building real wealth. So if you're serious about mastering your finances, make sure you hit that subscribe button. I've got a lot more of these step-by-step guides coming your way. And if this video is helping you out, smash that like button. It really helps me create more videos like this. Now that you know where to invest, the next step is figuring out which ETFs to actually buy. This is where most beginners get overwhelmed because there are literally thousands of ETFs to choose from. But I'm going to walk you through the exact process to narrow this down. Step 1. Define your goal. Ask yourself these simple questions. Do you want your money to grow as much as possible over time? Do you want regular income payments from dividends? Or do you want broad exposure to the entire market? Most people under 40 focus on growth. Most people over 60 want income, and almost everyone wants some level of market exposure. Your timeline matters too. If you're investing for 30 years, you can handle volatility. If you need the money in 5 years, you want stability. Step 2. Research individual ETFs. Once you know your goal, you need to analyze specific ETFs. The best free websites for this are Morningstar.com, ETFdatabase.com, and your broker's research section. Let me walk you through a real example using QQQ on ETFdatabase.com. When you search for QQQ, you'll see many different tabs with information. I'm going to focus on the first 3 tabs you should usually look at, but all of them contain useful information. First, look at the Stock Profile and Price tab. This shows you the basics. Here you can see the share price, the expense ratio, and what index it tracks. In this case, QQQ tracks the NASDAQ 100 index. You can also see it's categorized as large cap growth equities and focuses on technology sector. You should also check the Performance tab. This shows you how the ETF has performed over different time periods compared to its category average and broader market segments. You can see returns for 1 month, 3 months, year to date, 1 year, 3 years, and 5 years. When looking at performance data, it's recommended to focus on longer time periods rather than short-term returns. A 1-month or even 1-year return can be heavily influenced by temporary market conditions or lucky timing. 3 to 5-year returns give you a better sense of how consistently the ETF performs. However, keep in mind that past performance is no guarantee of future performance. Just because an ETF had great returns over the past 5 years doesn't mean it will continue that trend. Performance data is useful for understanding how volatile an ETF is and how it compares to similar funds, but it shouldn't be the only factor in your decision. Next, click on the Holdings tab. This shows you exactly what you're buying. QQQ's top 15 holdings include Nvidia at 9.67%, Microsoft at 8.33%, Apple at 7.68%, and so on. Notice how concentrated this ETF is. The top 10 holdings make up over 50% of the fund. And finally, check the Holdings Analysis Charts tab. This gives you the geographic exposure. You can see QQQ is almost entirely US focused at 94.7%. The sector breakdown shows it's heavily weighted toward technology at 53.87%. The market cap breakdown reveals it's almost entirely large cap stocks at 99.9%. Here's exactly what to look for in any ETF profile. First, the top 10 holdings. This shows you the biggest companies or assets in the ETF. Second, the sector breakdown. This tells you if the ETF is focused on technology, healthcare, or spread across industries. Third, the geographic exposure. Is this US only, international, or global? Fourth, the expense ratio. We've already covered why this matters. And fifth, the assets under management. Bigger ETFs are generally more stable and liquid. Step 3. Check for overlap. Look, when I first started investing, I made the classic mistake of buying 5 different tech ETFs thinking I was diversified. I had QQQ, VGT, XLK, FTech, and IYW all in my portfolio. I felt like such a smart investor spreading my money across all these different funds. Turns out, I was just paying 5 expense ratios to own Apple 5 times over. It wasn't until I actually looked under the hood that I realized,
holy crap.
these ETFs are basically all the same thing. This is where most beginners mess up. They think buying 5 ETFs means 5 times more diversification. But if all 5 ETFs own the same companies, you're just paying multiple expense ratios for the same exposure. Here's exactly how to analyze overlap using a real example. Let's compare VOO and VTI, 2 very popular ETFs that beginners often buy together. Go to wisesheets.io and look for their ETF overlap tool. Enter VOO as Fund 1 and VTI as Fund 2, then click Find Overlap. The results will show you several key statistics. First, look at the overlap by weight. This is the big circle chart. In this example, VOO and VTI have 87% overlap by weight. This means 87% of your money would be invested in the exact same companies if you bought both ETFs. Second, check the overlapping holdings table at the bottom. This shows you the specific companies that both ETFs own. You can see that Nvidia makes up 7.74% of VOO and 6.47% of VTI. Microsoft makes up 6.87% of VOO and 6.04% of VTI. Apple makes up 6.32% of VOO and 5.56% of VTI, and so on. Third, look at the sector differences chart on the right. This figure shows you the sector allocation differences between the 2 ETFs. You can inspect how much more or less each ETF has in technology, healthcare, financials, and other sectors. In this case, the differences are quite small, meaning both ETFs have very similar sector exposure. In this case, buying both VOO and VTI would be pointless. You'd get basically the same exposure, but pay 2 different expense ratios. Here's another example that shows good diversification. Let's compare SPY and QQQ. SPY tracks the S&P 500, while QQQ tracks the Nasdaq 100 technology stocks. Using the same process on wisesheets.io, enter SPY as Fund 1 and QQQ as Fund 2. The results show a very different story. The overlap by weight shows only 51% overlap. This means about half of your investment would be in different companies if you bought both ETFs. Much better diversification than the VOO and VTI example. Looking at the sector differences chart, you can see significant differences. QQQ has much higher technology allocation, while SPY has more financial services, healthcare, and industrials. This shows true sector diversification. In the overlapping holdings table, you'll still see the big tech companies like Nvidia, Microsoft, and Apple in both funds, but notice the different weightings. This is an example where buying both ETFs could make sense. You'd get broad market exposure from SPY plus extra technology focus from QQQ without massive redundancy. Alright, let's pause for a reality check here. I know this might feel overwhelming. We're talking about expense ratios, overlap percentages, correlation data. But think about it. You're learning skills that could literally save you thousands of dollars over your lifetime. The difference between someone who understands this stuff and someone who doesn't? It's not just a few percentage points. We're talking about tens of thousands of dollars in the long run. The key takeaway: overlap under 50% usually indicates good diversification potential. Overlap over 80% means you're basically buying the same thing twice. Most experts suggest keeping total overlap below 30% between your ETFs for optimal diversification. Now that you know how to choose ETFs, let's talk about the smart way to actually execute your investments and set up systems that work on autopilot. The first thing you need to understand is ETF correlation. This is basically how different ETFs move together when the market goes up or down. Even if 2 ETFs don't have much overlap in their holdings, they might still move in the same direction because they're influenced by the same economic factors. For example, a US technology ETF and a European technology ETF might own completely different companies, but they'll often move together because global technology trends affect both regions. Similarly, a large cap growth ETF and a small cap growth ETF might both fall when growth stocks are out of favor, even though they own different sized companies. The risk of having highly correlated ETFs is that you're not getting the diversification you think you are. If all your ETFs have high positive correlation, they'll all go down together during market crashes, giving you no protection. Even worse, if you have ETFs with negative correlation that are supposed to balance each other out, they might end up canceling each other's gains. For example, if you own both a growth ETF and a value ETF that move in opposite directions, your portfolio might stay flat while missing out on the gains from either strategy. Most brokers and research websites will show you correlation data, usually as a number between -1 and +1. A correlation of 1 means 2 ETFs move exactly together. A correlation of -1 means they move in opposite directions. And a correlation of 0 means they move independently. Most successful portfolios aim for ETFs with correlations below 0.7 between them. The second smart setup you should consider is DRIP. That's Dividend Reinvestment Plan. This is a feature that automatically takes any dividends your ETFs pay and uses that money to buy more shares of the same ETF. Instead of getting cash payments that sit in your account doing nothing, you're immediately putting that money back to work. Here's how to set this up. Log into your brokerage account and look for Dividend Reinvestment, or DRIP, in your account settings. Most brokers let you turn this on for all your holdings at once, or you can choose specific ETFs. Once it's enabled, every time your ETFs pay dividends, those payments automatically buy more fractional shares. This might seem like a small thing, but it's incredibly powerful over time. Let's say your ETF pays a 2% dividend yield. Without DRIP, that money sits as cash earning almost nothing. With DRIP, that 2% immediately starts earning its own 2%, and so on. It's compound growth on autopilot. Finally, let's talk about the most common mistakes that beginners make, so you can avoid them. The first mistake is over-diversification. Some people think buying 20 different ETFs makes them super diversified, but they often end up owning the same companies multiple times through different funds. More ETFs doesn't automatically mean better diversification. It often just means more fees and complexity. The second mistake is chasing performance. People see that some tech ETF went up 50% last year and immediately want to buy it. But by the time you hear about great performance, you're often buying at the peak. Most successful investors focus on consistency and low costs rather than chasing last year's winners. The third mistake is ignoring expense ratios. We covered this earlier, but it's worth repeating because it's such an expensive mistake. The difference between a 0.05% expense ratio and a 0.75% expense ratio can cost you thousands of dollars over decades. I've made every single one of these mistakes, so trust me, I'm not judging. I'm trying to save you from learning these lessons the expensive way like I did. The key is to keep things simple, focus on low costs, and let time and compound growth do the heavy lifting for you. The most important thing to remember is that ETF investing doesn't have to be complicated. Focus on low costs, broad diversification, and let compound growth work its magic over time. Now that you know how to invest in ETFs, your next step is to actually open that brokerage account and make your first investment. Don't wait for the perfect moment. Time in the market beats timing the market. More ETF investing videos will follow soon. In the meantime, you can watch my video on compound interest to really understand the huge potential of investing in ETFs. Thank you for watching. I'll see you in the next video.